And for those of you that are in attendance, we'll be able to provide you with this presentation so you can listen to it whenever you'd like, whenever you hit the gym in the morning, when you go for a walk, whenever you're driving, whatever. If you want to go back through and listen to everything, you are welcome to do that. A couple of housekeeping items. Over on the left-hand side of your screen, you should be able to see a Q&A button, as well as you've already shown me that you know how to raise your hand. But at any time during the presentation, if you'd like to drop a question in, and I'm actually going to share my screen now again for everybody. When you are in this Q&A section, you can actually broadcast a message. You can send a message to just me, or you can place a question that you might have at any time during the presentation in here, and we'll get to them as we maneuver through the presentation. So without further ado, I think it's time to go ahead and get started. And the goal tonight is to not only teach you something, but not to go incredibly long and take up too much of your time on a Tuesday evening. So trust me, I also have children, and I know how it works when we're running around and trying to get people to everywhere they need to go. Your time is valuable, especially this particular time and space we have in the evening with our families, so we're going to move through this quickly. The goal is to have it done with plenty of time to ask questions throughout. We will have two spots where I will stop and check for questions as we go through. So the way that this is structured, the first half of the presentation is sort of giving you a lay of the land, understanding how college funding works, understanding how you can prep yourself for the college funding piece, and understanding the FAFSA and how that works and how they calculate those numbers and how they come up with a number which is called your EFC, or your effective family contribution. The second half of the presentation is going to be a little bit more nuts and bolts about how you actually pay for college once you figure these things out and you've shopped around and you receive that letter in the mail that says that your child's been accepted to XYZ University, and now we would like your money. And their panic sets in, and you start to wonder, how on earth am I going to pay for all of this? We're going to kind of walk you through some of those steps as well. So, quick disclosure. Again, my name is Jeff Brainard. I will introduce myself again here in a couple of slides, but I am local to Denver. I am a certified financial planner, or a CFP. I became a member of the Capstone College Partners group, which is they introduced themselves through the Financial Planning Association to work with financial advisors that wanted to help families with this whole college funding maze and prepping themselves for college funding. So basically, I sat in a mastermind group with a few gentlemen who have generated not only the strategies and tested these strategies out for college planning and helping them with those strategies. There's also a group of people that created a software specifically to doing financial planning for families, getting prepared to send their kids for college. So I was lucky enough to be part of that. That's this disclosure I wanted to show you. The name of my firm is Noble Wealth Partners. We're based here in Denver. I am local to the Littleton area. I am a Columbine alum. Graduated in 1995 from the University of Colorado's Business School in 1999. I have lived here my whole life. This part of the state is very important to me. And I am the co-founder and an individual wealth strategist with Noble Wealth Partners. I am the college funding expert in-house, and this is what I spend my time doing, is helping clients in your situation prepare their finances, understand their finances, and get themselves ready to pay for college. So a little bit more about us. We were founded in 2017. I originally founded this firm under the name of Columbine Wealth Planning. I merged with another financial advisor last year. The new name of the firm is Noble Wealth Partners, but we've been around since 2017. Independent state registered investment advisor in Colorado. Prior to owning my own firm and my own financial planning practice, I spent 20 years in the great wild west of Wall Street, working for the biggest asset management firms around, basically helping financial advisors come up with investment strategies for their clients. So I've been doing this for a long time, and it's a dream come true to be able to work with people on my own and to have my own business. And that's the passion that I hope I can bring to this whole process. The reason for this slide is to show you our solution and where it fits in. And essentially what we're trying to tell people is what I am not, and that is not here to provide any assistance on writing essays. I'm not here as a college guidance counselor. being able to help kids figure out what they want to do with their lives and where they want to go to school that would best fit into that plan. Really what I do is try to pick up where those college guidance counselors left off, or people who do test prep, whatever that happens to be. And the idea of what we're doing here is financial planning for college-bound families, right? So that's what I focus on, is the financial side of this equation. With my software, I can help clients understand the scholarship situation, understand how student loans are going to work, understand their best funding strategies for college. But what I can't really do is help your kid get a better test score, right? So there are a lot of folks that do that in this world. I happen to think that we are experts in the financial planning side. You're not going to find anybody who can do a better job there. But if you're looking for some help with the test prep and the writing of essays and some guidance on some stuff, I would definitely recommend those of you with kids at Columbine High School to start there. And you can also reach out to me if you would like some other referrals. We are fee only. We do not sell products for commissions. What I am not is, I am not a stockbroker. I am not an insurance agent, and I'm certainly not here to take advantage of anybody or try to sell a product. The college landscape, and this is the reason why I think everybody is interested in coming tonight, is hopefully to learn a little bit about something that's the number one worry of families with children right now. The stats are pretty alarming. We're going to go through quite a few of those tonight. Only 17% of families are saving for college, and it's the number one worry that people have from a financial standpoint. It's not retirement, it's how am I going to pay for my kids to go to college. There's currently 21 million students enrolled in college. That number's as of 2015. I actually think that number's much higher. What we're going to go over tonight is essentially giving you a comprehensive college funding plan. We're going to look at maximizing student aid, talk a little bit about some effective EFC reduction strategies. Again, that is your effective family contribution. So we'll go into that and how that's calculated through the FAFSA. We'll talk about shopping for school, having a smart budget in place, and being able to do the college selection process from filling out the FAFSA and understanding the difference between the FAFSA and the CSS profile, as well as the percentage of need that you're going to end up with, or the net cost of college, understanding merit scholarships and other forms of aid, as well as the appeal process. We're going to talk about smart college lending strategy. That's a huge thing here when we talk about student loans, just give you the landscape of what types of loans are available. And really at the end, we're not going to spend a whole lot of time on tax and personal resource planning. That's stuff that we can go into if you ever want to reach out to us at Noble Wealth Partners, and me specifically, to go into a much more in-depth conversation of how to prep for these financial planning issues as you pay for college. But that's sort of a step beyond what we're going to be covering tonight. So you are more than capable of doing this on your own, right? You are more than capable. After what I show you a few things tonight, you're going to be totally fine to kind of figure out what your resources are. You're going to be able to help your kid essentially get themselves prepared for getting applications in on time. But I do want to point out that this is going to require time, effort. It's going to take some research and expertise, right? You're going to have to dig in and find out as much information as you can about the different schools your kids want to go to. And it's going to take some patience. Okay, you are very, very well equipped to go and do this on your own, but I do want to prepare you for what comes with that. I am also available for anybody if they want to have a free 30-minute call with me. You can schedule that at nwpplan.com. Right on our website, there's a spot where you can schedule a call. Under the reason for the call, if you just put college funding with Jeff, I'll know exactly what you're looking for and what you want to talk about, and I'll be happy to talk to you. You can also reach me on the phone at 720-598-8818 if you prefer to go that route. So let's start with some statistics. And we talked about 21 million kids plus. There's definitely probably a higher number going to school right now. And the reason I point that out is college is expensive. And the reason it's expensive is a lot of people want to go there. So there's a huge demand for this. And the colleges and the universities across this country know exactly how great their product is. So the cost of college has been going up much faster than inflation. Inflation's been low for 20 or 30 years. But I point this out to parents because even for somebody like myself, once I really started to get into the weeds and understanding what schools charge now, there's a lot of sticker shock, right? It costs much more than it did when you went to school. Okay, so we're looking here at this graph. We're starting with public four-year in-state schools. A lot of people tell me, well, my kid's going to go to an in-state school, right? That's always sort of we presume that to be the cheapest. And tuition and fees now on an annual basis up over $10,000 on average. Here in Colorado, University of Colorado is over that number. So is Colorado State University, right? That number's fairly outrageous. When I graduated in 1999, I graduated with right around $10,000 total in student loans. And now that's what it costs for 1 year. That doesn't even include room and board, which I think 11 grand is pretty light for Boulder. That's actually probably pretty light for Fort Collins too. Total cost of attendance, 21 grand. You're really looking between $25,000 and closer to $30,000 per year for an in-state school here in Colorado. And that is up on average over just a hair under 3%. Public four-year out-of-state school. Remember, all of the state schools have two different pricing structures for what they charge for people who live in-state and what they charge for folks that are out-of-state students, right? And that number is essentially double, right? I think is a fair number, and it's been rising at about 2.6% per year. Private nonprofit four-year schools, okay, $48,000 per year, getting close to 50. And Ivy League schools and all of the schools that are like Ivies, right? So we're talking about Stanford, Northwestern. You could probably throw Notre Dame in there, Georgetown, Vanderbilt. Those schools are now all north of $70,000 per year. And that is close to a 5% increase annually in those prices, right? So these numbers are very high, and you can it's almost a direct correlation to the amount of student loan debt that our students are acquiring. But I like to show people this graph. So listen, back in 2004, we were under $400 billion with a B. You have to do your best Dr. Evil impersonation when you do that. Less than 400 billion total student loan outstanding in 2004. That number is up to $1.52 trillion today. Right? It's an astronomically high number. And the thing that is getting concerning is you look at the top two colors there, the dark gray, the charcoal color, and the orange on the top of the bar. If we look all the way over to 2017, just about 20% of the student loans outstanding are for folks who are ages 50 and up. And essentially what that is not people who have graduated from college and couldn't pay back their student loans and now they're in their 50s and 60s. Those are parents who have taken on additional student loans above and beyond what their kids took out under their own names, right? So these are called Parent Plus loans. These are private loans in the parents' names. It is the fastest growing segment of student loan debt in the US. It is up 1,256% since 2004. And today, 7 in 10 graduates are coming out with student loans. Average student loan debt per borrower is $32,000. I can tell you with the clients that I work with, folks that are in their mid-30s, late 30s, early 40s, starting a financial planning discussion with my firm, this is pretty accurate. The number is typically somewhere in the $20,000 to $100,000 of outstanding student loan debt. And what $32,731 looks like in payments is $330 per month for 10 years. Okay, so that's kind of the rule of thumb is $100 per month for every $10,000 in loans that you take out for a 10-year time period. So one of the things that we work with clients on is sort of using something that they're familiar with, a mortgage pre-approval process. So they figure out a house that they like, the house that you might live in right now. You had to go and get pre-approved for a mortgage for that. And they tell you what you are allowed to spend, which typically for a bank, they're going to give you way more money than you need to for a house. But more than likely, if you went to them and said, I would like to purchase this estate right here, that I believe belongs to Jay-Z and Beyonce, right? You're not going to get approved for that mortgage, right? I don't know why, but generally speaking, I think when parents start to go through the process of figuring out where their kids would like to go to school and how they're going to pay for it, they kind of work backwards and they let the kids determine their dream schools first, and then they hope they can back into that number of how much money they have and are able to pay for it. So we're trying to flip that on its head here. Okay, we're trying to make that look something more familiar, to a mortgage pre-approval process. And the folks that I work with, they're based out of Ohio, who came up with this strategy that I've been working with them on testing this with different clients. It's called college pre-approval. Okay. And it's really simple. The idea is, one, we're going to determine personal resources available. So 529 plans, whether there's going to be grandparent help, all of the other potential resources you have to pay for college. We're going to establish a maximum student loan amount. So essentially what we're going to do is we're going to figure out what our student wants to do, what they're going to study in college, what they're going to plan on pursuing as a career when they finish school. Hopefully they have some idea where this is. And I know all 18-year-olds are not the same in that regard. And then we're going to figure out what a first-year salary is, and we want to keep the maximum student loans less than the first-year starting salary. And then once we have all of that figured out, we have a pre-approval amount, we know how much money we have a maximum student loan amount for our kids, then we can go shopping for schools within our budget, right? So it looks much more like the process of getting approved for a mortgage and going home shopping. Not all majors are created equal. I think you guys know this. If we go the route of getting an education degree and becoming a teacher, $36,557 is the College and Employer Salary Survey number from 2016, the average starting salary for a teacher. Computer science majors, that number's getting close to 72 grand. I know petroleum engineers coming out of the Colorado School of Mines were at like $103,000 starting salary at one point. That may not be the case anymore, but there was a time where that particular engineering discipline was in so much demand that they were getting six-figure starting salaries. Generally speaking, we try to figure out what that number is going to be, and then we establish that as our max student loan, right? We don't want to borrow more money than what our student is potentially going to make in their first year starting salary coming out of school. So this is what we do, and this is a spot right here where when you get this recording, if you want to come back to this particular point, if you want to take these notes right now while I walk you through this, this is what you would need to do to get yourselves prepared for understanding your resources. So this is what I do with our software, which is called College Aid Pro. We walk through and we help clients get themselves organized. We understand what their 529 savings balance is, how much they've actually saved for college, right? In a 529 plan, and what they're contributing to that. That is typically the most common way we see people saving for college. It is an excellent way to do it. It's not the only way to save for college, by the way, but that's for another time. But we figure out what that number is and what that number is going to be when they start. So that first is 529 savings balance today. The second line is I'm saving $200 a month for my student, and he or she has 50 more months until they go to school. In this example, that's going to be 10 more grand that we add, and that total then is the third line, $34,000. That's our total 529 savings plan target that we have for our kids' start of college number. Parent pledged assets. Okay, this fourth line down, this is any amount of money that you are going to utilize in addition to what you've saved for your 529 plan, right? That could just be a simple investment brokerage account. It could potentially be your IRA or your Roth IRA. That is a very serious discussion you need to have with your financial advisor if you're going to go the route of using retirement money that's earmarked for retirement for college. But you can do that without penalty. But I would recommend that you talk to a financial advisor first. But at whatever that number is the fourth number there, parent pledged assets. The one that parents forget about the most often is this next line, and that's parent pledged monthly cash flow. Okay. The way I explain this to folks is you are paying a certain amount of money to have your child live with you right now. And I'm sure those of you like me, I have an almost 16-year-old sophomore there at Columbine who lives in my house. He probably eats through most of that $400 per month. And I'm sure you can sympathize with that, right? So the idea behind this cash flow number is just saying, well, I'm moving them out of my house, but I'm still going to be providing for them. So whatever that number might be, it might be $150 a month. It might be $200 a month. It might be $400 a month. You start to grasp what that number is going to be, and it's going to be over the course of 4 years. That amount of cash flow that you're going to be providing to your kid while they're in school, that has to factor into this number. And that number is close to $20,000 if we're planning on cash flowing about $400 a month for our kid while they're in school. American Opportunity Tax Credit. This one missed by so many people. This one is it's basically a coupon for $10,000 of money that you get back as a tax credit if you spend your money correctly. Okay, so we go up one line item, that the parent pledged monthly cash flow or the parent pledged assets. As long as we're spending some of our own money on every given year, and that number needs to be about $4,000, the government is going to give you a $2,500 tax credit on your tax return. And you're going to get that 4 years in a row. And the AOTC is essentially going to give you $10,000 off your college expenses in the form of a tax credit. It's a huge opportunity, but if you're using all 529 savings plan money, you're missing out on the AOTC. Student pledged assets. We're going to talk about why these can be disadvantageous, but if your student is saving for their own college, I applaud them. I think that's fantastic. We have a line item there. We're going to factor in some student cash flow for them while they're in school, $200 a month on average, get them about another 10 grand. Grandparent help, we have that line item in here, but it's something you have to factor in, or other help from aunts, uncles, relatives, friends, who knows. You put that on that last line item, and the total number we get to is $98,000, okay? This little exercise is gonna get you super organized for being prepared to how you're going to pay for that 4, maybe 5 years of college, maybe 7 years like my friend who went there a little too long up in Boulder. If it's gonna be 7 years, I highly recommend you save a lot more than you do right now. But that number that we come up with for a 4-year college pre-approval amount is $98,000. So putting that into practice, right? So this is going a little bit further with my software. In this particular example that we're showing, it's Penn State University out-of-state tuition. If you look from 2020 and the 2021 year starts on the left-hand side. So let me get a laser pointer really quickly here. So this is 1 year's worth of college expenses. This is the freshman year for our example student here who's looking at Penn State. This is their sophomore year. And then we go into their junior year and we go into their senior year. Couple of interesting notations. We're adding a +1 here. That means our second student is in school. That brings down the amount of money that the school is going to ask from you from a net cost perspective, potentially, because it increases your it decreases your effective family contribution. So you could possibly get more student aid once that second child goes into school, but that's a topic for another day. But showing you here really quickly, the sticker price, the net cost after sticker price for an out-of-state student to go to Penn State, right around 50 grand per year, total of 200 grand. We did a pre-approval amount of roughly $98,000. That's $98,200. We split that across the 4 years. We have a funding gap of about 110 grand. So just like that, we've already know that we're going to have to borrow some money. That's an extraordinary amount of money. And the federal student loans that our student can apply for, the max is $27,000. You can't get more than that as a student, and honestly, you can't get less than that. So you're going to get that $27,000 regardless of how much money you as parents make. These student loans are the most advantageous for the students. The interest rate's the lowest, but because of that, these federal student loans, they max you out at 27 grand, and it comes out to the students in exactly this amount: $5,500 as a freshman, $6,500 as a sophomore, $7,500 their junior and senior years. After all of that, we still have a funding gap, and it's $83,000. Okay, so as a parent, that's going to keep me up at night. And if my student has to take out $110,000 worth of loans, they're going to be paying $1,221 per month for 10 years, or $700 a month for 25 years. It looks like a mortgage payment. So when you in the 25 to 38-year-old age gap and not being able to buy a home, it's because they have student loans in excess of $100,000 that are essentially hitting their pocketbook as a mortgage. So your strategy, and this is where we're going to get into the FAFSA and kind of take this full circle on how you get approved for these. But I want to give you guys the overall view of what these student loans look like. Okay, so we talked about the federal direct loans, that $27,000. That's called a Stafford loan. Those, again, $27,000 max, and you're going to get that. Every student can get that number. okay, regardless of how much the parents make. If there's a need-based component, it will be subsidized. What that means is there will be no interest accrued while they're still in college, right? So if you have a slightly higher amount of need based on your income and your assets, you potentially could get a subsidized Stafford loan. If you don't need that, dependent on your income, so maybe you make a little bit more money or you have a lot more money saved for your student, the interest rate's not going to change, but the interest accrues immediately while you're in school. Okay, so there's either a need-based Stafford loan or a not need-based, but regardless, that number is going to be $27,000 for 4 years. I think it's really important to note that that is a use it or lose it number. So if you go into your child's freshman year and you say, I don't want them to have a student loan, and you opt not to get this $5,500 as a freshman, you can't then, as a sophomore, say, I think it's going to take me 4 more years to be in school. I would now like my $27,000. They will not give it to you. You will only be eligible for the $6,500, $7,500, and $7,500 at that point. Okay, so this is a discussion that you have to have with yourself, with your student. Even if you don't need the money, it might make sense to hold that money so you have it in case you need it later on. Okay, you really need to be prepared and wrap your arms around how much money you're going to have for college and understand that, because that use it or lose it component for the federal student loans is a very important topic. Parent Plus loans down below, these are also federal loans. These are not need-based, but when we talked earlier about the amount of student loan debt that is going and creeping up at those age brackets of 50 and older, this is generally where that is coming from. These are these Parent Plus loans that start with a 5% almost origination fee, and they have a 7% fixed interest rate that starts accruing immediately. It's borrowed by the parent up to the full cost of attendance, and it is not transferable. So it is something that you will pay off going into your retirement. And these interest rates adjust every July 1st. There's also private student loans, and we see a lot of these, but once you get into above and beyond cost of attendance, or if the parent does not want to take part in these plus loans, you can do a private student loan with a cosigner that's going to be required as you, the parent, most likely, and you can borrow them from banks and credit unions. I will tell you that that interest rate is going to be even more onerous than what we just saw with the Parent Plus loan, right? So the best loan strategy is to try to keep us in this federal direct Stafford loan world. How do they come up with those? Oh, excuse me. We're going to go real quick back into the AOTC. American Opportunity Tax Credit. I talked about this. This is essentially that $2,500 tax credit or coupon towards your college expenses every year. There's a phase out. So if you make over $180,000 married filing jointly on your adjusted gross income, that will phase out, right? But if you make less than 180K, you're going to get some level of that 2,500 credit. Less than $160,000 per year as a family, married filing jointly, excuse me, you'll get the full 2,500 credit every year as long as you're spending $4,000 of your own money. So this is how that breaks out. You get 100% of the first $2,000 you spend of your own money towards tuition, fees, and books. You get 25% of the next $2,000. That total, $2,000, 100% of $2,000 is $2,000. And 25% of the next $2,000 is $500. That's where we get the $2,500 tax credit, okay? Those are important numbers along with student loans. And I think it's important to remember that college is a business. You know exactly the value of these things. So is it getting expensive? Yes. Is it worth it? Absolutely. Your child is going to make a lot more money coming out with a college degree. Now, graduate degrees, we could argue a little bit whether or not those have become a little bit overvalued. But a couple of spots where I would encourage you to go look at where are you planning to study? Where is your kid planning to study? What major do they want to pursue? Understand how job placement opportunities coming out of that school work. Understand how financial aid is awarded. So these 3 websites are amazing: collegescorecard.ed.gov, collegeboard.org, and collegedata.com. Go to these, review your schools, shop for schools, talk to your kids about the schools, and understand how financial aid is awarded at those schools. So, financial aid. Student loans are just one piece of that. There's also merit-based aid, scholarships, gift aid is the way we look at that, right? So they're awarded to recognize outstanding academic performance, talents, leadership, obviously athletics. We'll talk about how those scholarships break down as we work through the presentation here. And then there's also need-based aid. So that's gift aid, scholarships and grants because your child needs that money. The full cost of attendance is higher than what your effective family contribution is. There's also self-help, student loans, work study. I personally had a job working in the cafeteria when I was a freshman up at the University of Colorado. I hated every minute of it, but I did get some money that way towards my meal plan. So that those types of things are available for your kids as well. Lots of different sources of financial aid. Understand all of those. And I think it's really important to understand what type of family you are. So if your kid is a high merit student, but you don't have a lot of need for financial aid, you make a lot of money, or you have a lot of money saved, you're in the upper left-hand quadrant. You have a high merit student and you have a lot of need, you're over in number 3. The interesting thing about these different quadrants is I will have people come up to me and be like, my friend just had a cousin whose kid lives in Des Moines, Iowa, and can you believe that? And when I hear that, I can almost place you exactly somewhere in this quadrant just by hearing that. First of all, I know that Harvard doesn't give scholarships, so they didn't give a scholarship, but they do grant all of your need, right? So if you get into Harvard and you need $50,000 to attend, Harvard will pay that $50,000 for your student per year to go to Harvard. Okay, we'll explain a little bit about how that works. There's also low merit and low need. So you make a lot of money. Maybe your kid hasn't really grasped what they want to do yet, and they're struggling in high school, but they know they want to go to college and they've got some potential. They're going to be in that lower left quadrant, and then low merit and high need over in 4. So understand where you are when you're shopping for school, and then you can understand how to cut the cost numbers. Okay, so we have high merit, low need. Over in quadrant 1, we're looking for private scholarships. We're going to be really good with school selection, test prep to increase our test scores. Those are all ways we can cut the cost of college. If we're over in quadrant 3, 100% of needs going to be met. We're looking for merit aid and private scholarships, and we really want to try to reduce our effective family contribution in order to increase the amount of need we're going to qualify for, right? So all of those different strategies, these are things that I go into with clients whenever we do a deeper dive. So this is how we're going to bring this all together. Okay, so there's total cost of college each year minus your expected family contribution or your EFC. Okay, that's going to be the amount of financial need you are going to be granted. So if the college cost, the total cost of going to the school is $50,000, and after you fill out the FAFSA, your expected family contribution is $20,000, you have $30,000 of need as a family for your student. Okay, so if they were to get accepted to Harvard, I mentioned earlier, Harvard doesn't offer scholarships. Harvard will pay 100% of that $30,000 of need if your student is accepted there, right? There's a few other schools that fall into that category. If the cost of the school is $20,000 and your effective family contribution is $20,000, there's $0 of need. So you're not going to get any of that automatic need. The EFC is split when multiple children are in school. So we talked about that. 2 college students, your effective family contribution or expected family contribution is 20. It actually ends up being 10,000 each. The amount of need that you can qualify for each student goes up. Okay. Of how this process works, right? There's going to be a sticker cost for college. There's going to be the expected family contribution, and then there's going to be a net cost of college. So you want to know these things, and you can get an idea of what your EFC is today at collegeboard.org and collegedata.com. They both have little EFC calculators. I'm also going to walk you guys through that right now, and there's net price calculators at both of those websites. They're great tools to start shopping for school. So real quick time check. It is 6:37. We're doing okay, and we're going to speed up a little bit, and I will check for the first round of questions here in a little bit. Understanding the FAFSA. So this is the The free application for federal student aid is what FAFSA stands for, financial aid application. 90% or so of the colleges and universities across the country are going to utilize the FAFSA to understand how much student aid they're going to give your student, okay? 3 weeks ago, so today is October 22nd, I was looking through, and I know we have a lot of 2021 graduates and 2022 graduates and families in attendance today. If your child is a senior right now, it's not too late. They started the FAFSA applications on October 1st for seniors in high school. I would recommend you have about 9 days to beat the November 1st deadline. So as an incoming freshman or a senior in high school, they really recommend you get that FAFSA done in that first month. And so I would tell you to start getting yourself prepared to do that as soon as possible, whenever we get done with this presentation. For those of you with juniors, sophomores, freshmen, be prepared for that year. When your student is a senior in high school, that fall, October 1st, is when you can fill out the FAFSA. Do it sooner rather than later. I would tell you to do it right away. And when we look at the financial aid for the class of 2020, so our seniors right now, this kind of works backwards, right? College is not that far away. It's quite literally a year from now, they're going to be in school. And admission applications, you want to start applying by November 1st for colleges. So we're working backwards, right? So FAFSA is available on October 1st of their senior year. File for that by November 1st. And the tax figures they're going to use is your prior year. Okay, so I hate that terminology. It sounds ridiculous, but if your student is a senior right now, they're going to use your 2018 tax year. And they're going to use all of your asset figures based on the day that you file. Whatever you have in your 401k account, we're going to go into that in a minute. Okay, so if your student is graduating in 2021, they're going to use the 2019 right now, this year that we're in right now, they're going to use this year and the taxes that you file for this year that are due next April. If your student is a class of 2022, they're going to use the 2020 tax return, right? So that's where we get prior year. We go back 2 years to figure out what that number is. FAFSA formula basics. So your parent assets are treated much nicer on the FAFSA than the student assets. So anything that is held in your student's name is going to be counted at 20%. Whereas if it was in your name as the parent, it's going to be 5.64% or less. Okay, that's why 529 plans are so popular, because they are college savings vehicles that the parent owns. It is in the parent's name and the beneficiary is the student. Okay, so it gets beneficial treatment on the FAFSA, but it is specifically for college and for the student. An UGMA or an UTMA, those are trusts for minors, right? Those are counted at 20% for the FAFSA application. So that's one thing I recommend to clients is shifting money out of those trust accounts and into a more FAFSA-friendly 529 plan. Parent income, that's also treated in a much nicer way, although your income is much higher than your students. And then your student, anything above $6,350 allowance is going to get counted at 50% towards their effective family contribution number. So I only am showing you this. This is not something that you would ever need to know. These tables are readily available when you go to the FAFSA website if you want to see it. But I point this out to be something that I find to be absolutely ridiculous about this whole process, okay? I tell clients all the time when they fill out the FAFSA and they get their EFC, or if they go through like collegeboard.org, for example, to get their sample EFC right now, they're going to be blown away by how high that number is. To give you an idea, this table, if we went all the way down on the left-hand side with my laser pointer, for a 45-year-old parent, they're only going to allow you a $5,500 savings allowance. So they're saying everything you have outside of your retirement accounts, because I don't use the retirement account balance, so in your 401ks are safe, you're only allowed to keep $5,500 of that, and the rest of it we want you to use for your student's college, okay? That's how they factor this in. I find that number to be insulting and I can't stand the way it works, but I don't make the rules. So what is accessible on the FAFSA? Everything on our left-hand side. Cash, stuff you're keeping in the savings account. 529 plans, right? They're assessed at a reasonable rate for the parents. but they're also assessed for all your children. So I have 3 kids. My oldest is a sophomore in high school. All of my 529 savings plans are going to be assessed when my first goes to college. The Coverdell accounts is another way to save for college. Any mutual funds that you have in taxable accounts, stocks, bonds, rental real estate, your equity in those, and vacation property equity, those are assessable. Non-assessable assets, again, retirement accounts, so traditional IRA, Roth IRA, 401ks, pensions, annuities, cash value in life insurance, home equity. Although I will tell you, cash value life insurance is one that is on the table. That one is probably going to get added sooner rather than later to an assessable asset. And then you have home equity, which is not, but it is on the CSS profile. And anything that you value that you own in a small business or a farm is non-assessable. So the FAFSA guide, actually, I'm going to skip through this. This is an income protection allowance. Again, it's also super insulting. And the reason I bring this up is essentially what they're going to do when they're factoring in what your effective family contribution is. They want to take as much of the money that you have available for your student. And they also recognize that people try to game the system. Okay. So unfortunately, that's why those numbers are so insulting. But to give you kind of a rundown of of how this works, the adjusted gross income, line 7 from your 1040, plus anything that you added to your retirement contributions, right? This is the first one I want to point out because some people are like, well, maybe I'll just shove a ton of money into my 401k plan. It'll bring my income down for the year that I'm going to file my taxes. And then I'll be able to show a smaller number and increase or decrease my effective family contribution and increase the amount of aid I can get from my students. Nope. They totally understand that would be something people would do. And that's why they add your retirement plan contributions back. They add any untaxed income that you might have, veterans benefits, Social Security income that you're getting, as who knows why. Those are some of the untaxed income items. And they give you an enhanced AGI. Then they use your income protection allowance. They take out any taxes you pay. That then becomes your available income plus what you have assessed in your assets. And then they give you your effective family contribution. And this is the easy way to look at it. So let's just bottom line this. We're not even looking at assets that you have saved here. This is for married filing jointly, adjusted gross income, depending on the number of dependent children in your home. So if you and your wife or you and your husband are filing taxes and have $150,000 of adjusted gross income, married filing jointly, you have no other savings for college, the FAFSA, and you have 2 students, the FAFSA is saying that we expect you to take $31,933 per year from your income and pay for your kids' college, okay? Again, I find it insulting. The number is really high, but that is how this works. That is the calculation that the FAFSA uses to decide how much student aid your student will receive. So the number, the more dependent children you have, that number goes down. And the lower AGI you have, that number goes down. So this table is a really nice, effective way to just kind of get a handle on what your EFC is going to be. Financial aid applications and formulas. So FAFSA is the one we're talking about, right? That's 90% of the schools. October 1st is the date. CSS profile. So those are select elite colleges, your Ivies, your Stanford, your Notre Dame, your Duke, your Vanderbilt. They're all part of the CSS profile. If you have a student that's looking at those, you're going to have to fill out both the FAFSA and the CSS profile. Okay. 2 different formulas, institutional formula and federal formula. There's also the 568 Presidents Group. This is, again, an even smaller group of very elite universities are part of this, and they're trying to offer need-based aid for as best they can for students. The 568 Presidents Group, though, is the least likely location where you're going to be applying for a school. I'm not going to get too much into this for the sake of time. We're at 6:46 right now. Key differences in the federal method versus the institutional method. That's the CSS profile. Not much you need to worry about here, but just remember the understanding here is they're trying to get an idea of how much money you make, how much do you have saved, and how much of that do we expect you to use to pay for your kids' college. And then if that, whatever that number is where you're going to get your need-based aid. I'm going to skip through this one. This is a EFC enhancement study. Essentially what this is you might have, parents have some credit card debt. They have $65,000 in investments in taxable accounts, pay off that credit card debt to reduce the amount of money that you have sitting in taxable accounts, to reduce the amount of interest you're paying. That's great because it's gonna reduce your EFC and enhance the amount of student aid you could get. The other one that I talked about, trust accounts, converting an UTMA or an UGMA into a custodial 529 plan is a way to reduce the amount of money that's in your student's name and put it in your name for a better assessed value. Okay, we're skipping through these because this is obviously stuff that needs to have much more detail. So quickly, I want to go look at questions that we might have. I understand we need to complete the FAFSA each year that our children are in college. I have a freshman in college right now. Do I need to resubmit the FAFSA before November 1st? Great question. You actually need to do it every year, but there's less time sensitivity on when you get it in if you have a freshman in college. Okay, so you actually have until June to fill out the FAFSA again. I would not wait that long, but you don't have to worry about doing it before November 1st. We also had, how does the FAFSA work for divorced parents? That is a very detailed question. Essentially, what they do is they figure out which parent the student lives with the most. And quite literally, it is the number of days. And because there's generally an odd number of days in any given year, whoever has the student for 365 divided by 2, right? Whoever has them for one more day is whose income is used on the FAFSA. But I will also say, if you were remarried, that and the student happens to live with you the most in any given year, your new spouse's income is going to go on to the FAFSA. And yes, I will make a copy of this presentation available for download. There shouldn't be a problem with that. Actually, I'm not going to say yes for sure. I'm going to doubly make sure that I am allowed to present that out for download. But the replay of this presentation is going to be available. Okay, 6:49. I want to get you guys out of here in the next 5 minutes. So I want to touch on just a few more things. And we talked about cutting the cost of college. We understand the FAFSA a little bit now. We've talked about these quadrants: high merit, high need, low merit, high need, all of that kind of stuff. Where does my student fit into this world? And we talk about scholarships, okay? So believe it or not, athletic scholarships are less than 1% of the amount of scholarships that are delivered every year. Okay, private scholarships about 13%, but generally speaking, institutional grants and scholarships are the lion's share of the amount of money. There's a very good chance that your student is going to get some form of scholarship. The number I heard the other day from somebody else in this profession, which kind of blew my mind, is your student should take on the application of scholarships as a full-time job right now if they're a senior. The average student should apply for 50 scholarships, and the average student is going to get 1 out of 12 awarded to them. Okay, they apply for 50, they could expect to get somewhere in the neighborhood of 6 to 8 scholarships. And those, when we're talking about those could potentially be a private scholarship worth $500, right? But your student is going to have to put some effort into this. And they can get some scholarships that are going to help them. But I think it's important to understand the different type of scholarships. There are competitive scholarships. So here in Colorado, the one that's very famous is the Better, right? That's a very famous competitive scholarship. You have to be the best of the best, the very elite students, and you're going to compete for that money. That's a perfect example of a competitive scholarship. Presidential scholarship up at the University of Colorado, also a competitive scholarship. But great scholarships also exist in the grid automatic. So they kind of look like competitive, but they're slightly different, right? Because it's not going to depend on how many people apply for an automatic scholarship. It's just going to matter what your student's test score is and what their GPA is. And if they hit a certain number, they're going to get that automatic scholarship. A package scholarship is generally at private schools, and they're where if they're looking for a certain student who wants to study a certain discipline and they want to bring them in with a package, they can potentially reduce tuition instead of just awarding actual scholarship money. So anyways, more complicated, but for another day. They're the least likely scholarships. The most likely you're going to look at are competitive and automatic. And the most important slide I wanted to get to before the end of the presentation today is this one on the University of Alabama. For whatever reason, the schools down in the Southeast, the SEC conference, football conference, if you're familiar, Southeastern Conference, they have a lot of opportunity right now for out-of-state students. So the University of Alabama is the one we're using in this particular explanation. I have personal experience. The son of my cousin, so I guess that makes him my second cousin, he actually got a 33 on his ACT, and that was worth $22,000 per year from the University of South Carolina. It almost covered the entire enchilada for him to go to the University of South Carolina as an out-of-state student. And it was an automatic score. In this particular one, right, they've got these different bands, but these are ACT scores. Your student gets a 32. University of Alabama is going to give you $104,000 over the course of 4 years for your student to go there. Okay, that's a huge, huge, huge thing to understand. So when you're shopping for schools, I don't know if the University of Alabama is appealing to your student, but if they're an incredibly bright student, $104,000 automatic scholarship is pretty handsome. So understanding merit and need-based aid. We kind of touched on this earlier. The University of Alabama, we just went over. These schools, Baylor, Case Western Reserve in Ohio, Denison is in Cincinnati. Again, the folks who created this presentation, they're Ohio-based, so forgive them for not having any Colorado schools here. But the 100% of need met. So we talked about Harvard, and we talked about the example I told you where somebody came to me and they said that their cousin's friend in Des Moines, Iowa got a full ride scholarship to Harvard. They did not. Harvard does not give out scholarships. Neither does Notre Dame, unless they're athletic scholarships. But neither does Northwestern up in that upper left-hand corner, or MIT. Those schools will meet 100% of your need. So if you fill out the FAFSA and you have a $32,000 EFC and it costs $72,000 a year to go to Northwestern, Northwestern will guarantee you that they will pay you that $40,000 gap. Okay? So those are for those CSS profile schools, those elite schools. They're similar, the Ivy League schools plus the Ivy-like schools fall into that 100% of need met. And then over on the left, you also have merit-based aid where they're giving you scholarships for your grades. I want to skip through these. I want to show you this last slide, and then we're going to kind of wrap it up from here. This is looking at Miami of Ohio. So that's Miami University there. Ohio State University is second. University of Dayton is the third there. Columbia is an Ivy League school in New York. Denison is a private school in Cincinnati, I mentioned earlier. And then Penn State is the out-of-state school that they picked for this particular example. They have sorted this within our software package that we use for clients based on the net cost. Okay, so the Miami of Ohio, the cost of attendance is $32,000. For this particular student with a merit scholarship of $20,000, their net cost is $12,000. Right? You compare that to Ohio State, which is actually cheaper, sticker price, $28,159 for an in-state student, but they get less of a merit scholarship, $26,159. Okay? I find this happens a lot here, and I will use my alma mater, which I love very much, the University of Colorado. They will give out scholarships. Their full cost of attendance is clearly lower than a lot of private schools or out-of-state schools. But if I could potentially have a student in my house that gets a really high ACT score and could go to the University of Alabama for $104,000 off on a scholarship, it is going to be cheaper for my student to go to the University of Alabama, lower net cost, right, than to stay in-state and go to the University of Colorado. They won't be able to get that type of merit scholarship to go to an in-state state school, okay? That's why the most important thing is going to be the net cost versus the stickered price of school, right? Columbia University is still expensive. MIT is still expensive. And you know, if your EFC is $50,000, even if MIT will guarantee to pay the difference between $50,000 and $75,000 a year, you're still going to have to come up with $50,000 a year. Okay, so understanding those net costs of our schools, they can be very, very different. Even comparing state schools to each other, understanding what our funding gap is, how we're going to approach that with student loans. So let me go back to my laser pointer right here. So this is looking at our funding gap. This particular sample student that we started with the $98,000 pre-approval amount, there's no funding gap. They don't need any student loans because of the merit scholarship they can get there, an automatic grid scholarship. Ohio State, even though it's a state school, it's still going to end up having a funding gap for this particular student. Okay, so that's really kind of the reason I show that to folks, is I want to show them the important factor of net cost versus the sticker price. Okay, this is a FAFSA document checklist. This is going to be emailed to everybody who signed up and attended tonight, something I put together for people. So you will have this number or at your disposal whenever it's time to do your FAFSA. One thing I want to point out to everybody, so a really, really common mistake is people put their retirement plans, their 401ks, their Roth IRAs, their IRAs, just from pure confusion, because this financial services business I'm in is really good at confusing people. They put that under their investment accounts, and those are different things. They're looking at investment accounts or stuff that you're holding in a taxable account. Retirement plan assets are factored in at a much lower rate on the FAFSA, so don't make that mistake when the time comes. So with that, folks, 6:58, I really, really appreciate everybody's time. I want to flip really quickly again to my last slide here. My name is Jeff Brainard. Noble Wealth Partners is the name of the firm. nwpplan.com is our website. Okay. The phone number is 720-598-8818. And again, I'm offering just, free call, 30 minutes. If you want to kind of chat about any questions that you still have about this very, very confusing process, that's great. If you really want to go into the deep dive, we do hourly planning engagements with folks, and we can discuss that. But if you're looking for just getting some questions answered, I'm happy to help. Again, I'm a Columbine alum. All my kiddos are going to Columbine. It holds a special place in my heart, and I appreciate everybody for coming out tonight. With that, I'm going to stop sharing, and I'm going to bid you all a wonderful evening and wish you the very best as you go through this process of getting ready for college. Thanks so much, everybody. I appreciate it.